Hey investors, are you ready to make some serious money in the stock market? Listen up, because today we're diving headfirst into the thrilling world of corporate actions. These babies are the game changers, the movers and shakers that can send your portfolio soaring or plummeting faster than you can say sell, sell, sell. Corporate actions are basically financial maneuvers companies use that can send their stock prices on a wild ride. We're talking stock splits, dividends, buybacks, the whole shebang. And let me tell you, understanding these actions is like having insider information. It can give you a serious edge in the market. So buckle up, because in this video, we're breaking down the 5 most important corporate actions you absolutely need to know and how they can impact your precious investments. Trust me, after this, you'll be trading like a Wall Street pro. First up, we've got dividends, the bread and butter for income investors. Think of it as a reward for holding onto a company's stock. The company shares its profits with you, giving you a piece of their hard-earned cash. Now, here's the kicker, the ex-dividend date. This date is crucial because if you buy the stock on or after this date, you won't get the next dividend payout. But that's not all. On the ex-dividend date, the stock price typically drops by the amount of the dividend. Why? Because the cash is leaving the company's coffers. Now, this dip is usually temporary, but you need to be ready for it. It's like a mini sale on your favorite stock. So keep your eyes peeled for those dividend announcements and mark your calendars for the ex-dividend dates. Remember, a bird in the hand is worth 2 in the bush, and a dividend in your pocket is better than a potential capital gain. Next up, bonus issues. Companies love to shower their shareholders with gifts, and bonus issues are no exception. It's like getting free money, right? Well, not exactly. A bonus issue is when a company gives out additional shares to its existing shareholders for free. Sounds great on the surface, like getting something for nothing. But here's the catch. It doesn't actually change your total investment value. Think of it like slicing a pizza into more slices. You're getting more pieces, but the overall size of the pizza remains the same. However, there's a strategy behind this madness. Companies often issue bonus shares to make their stock more affordable, attracting more retail investors like you and me. It's a psychological play, making the stock seem more accessible and boosting liquidity. Now let's talk stock splits, the corporate action that's all about appearances. It's kind of like getting a new haircut. You look different, but you're still the same person, right? In a stock split, a company increases the number of outstanding shares while simultaneously reducing the face value and the price per share. It's a bit like trading a $100 bill for 2 $50 bills. You have more bills, but the total value remains the same. The idea behind a stock split is to make the stock more attractive to investors who might have been scared off by the high price tag. It's all about perception, folks. A lower share price can make the stock seem more affordable and potentially attract more buyers, driving up demand. Hold on to your hats, because things are about to get serious. Rights issues, my friends, are not for the faint of heart. They require careful consideration and, honestly, a bit of number crunching. Picture this. You own shares of a company, and they announce a rights issue. This means you have the exclusive right but not the obligation to buy additional shares at a discounted price. Sounds tempting, right? Well, here's the catch. It involves putting more of your hard-earned money on the line. Before you jump in headfirst, you need to evaluate if it makes financial sense for you. Ask yourself, do I believe in the company's future? Is the discount attractive enough? Can I afford to invest more capital? If the answer is yes, then a rights issue can be a great opportunity to increase your stake in a company you believe in at a bargain price. Last but not least, we have buybacks, the corporate action that gets Wall Street buzzing. Think of it as a company investing in itself. When a company decides to buy back its own shares, it's like they're saying, "We believe in our future, and we think our stock is undervalued." A buyback reduces the number of shares available in the market, which can drive up the price. It's a classic case of supply and demand. Plus, it also increases the earnings per share, making the company look more profitable to investors. Now, buybacks can be a great sign for investors, as they often signal that management is confident in the company's prospects. But remember, always do your due diligence. There you have it, folks. The 5 most important corporate actions that can make or break your portfolio. Remember, these actions can have a significant impact on stock prices, and understanding them can give you a serious leg up in the market. Don't get caught off guard. Before you hit that buy or sell button, make sure you understand the implications of any upcoming corporate actions. Knowledge is power, and in the world of investing, that power translates into profits. So, do your research, stay informed, and remember, the stock market is a marathon, not a sprint. Happy investing!